Quick note, the coupon code for the amazing courses and private live streams on stocks, money, and real estate does expire at 7 p.m. tonight. Sorry I had to extend that. There were too many emails and I've caught up. Hey everyone, Meet Kevin here. Will the Federal Reserve bail us out again? From our September 2nd peak, the S&P 500 is down 8%. David Einhorn, the hedge fund manager who sued Apple and shorted Tesla, says the market hit a peak on September 2nd, and the Dow is also down 8.3% from September 2nd. Today, all three of the big indices are down 3% each. A lot of money is flowing out of stocks and into bonds as people are panicking, and Bitcoin is up over 30% just this month. This is all happening as people look towards Europe and say, oh crap, they're locking down again. Deaths are rising, even though mortality rates are down, cases are up and away. And now we're starting to see similar signs in America. In fact, the reality is it would not be surprising for us in the United States to see COVID cases jump over 100,000 cases per day within the next couple weeks, if not even potentially as many as 140 to 150,000 cases per day. That is, if this spread continues. And this begs the question, are we going back to the days of March, where the stock market circuit breakers kept tripping because the stock market was selling off 7% per day, day after day after day after day, leading to the biggest crash we have seen since the Great Recession? Are we heading back to those days where it literally felt like we were putting money into an open flame and burning it for fun, except nobody was laughing? We were all in pain as our money evaporated and the market freaked out. Unfortunately, the answer might be yes. Things might get substantially worse before they get better. And we talked about rising cases coming and this second wave's danger for weeks now, which is one of the reasons we completely bailed out of recovery stocks, which have massive bankruptcy risks via a second wave. Recovery stocks like airline, travel, hospitality, and retail haven't even fully recovered from the first wave or the summer wave, and now we're building a third wave on top of the first and second. The debt levels at these recovery stocks will be absolutely miserable, and the bankruptcy risk rises by the day. However, even tech stocks are pulling back, which we generally see as safe from a pandemic and potentially even beneficiaries of a pandemic. And that's because, well, we're seeing everything sell off. Many people are moving money out of the markets right now for fear of what's to come, especially with the election just 6 days away. And so the question now is, if the market continues to sell off, will the Federal Reserve bail us out again, or are we on our own? Well, to understand this, let's try to see what three options the Federal Reserve has. Number one, the Federal Reserve can buy mortgage-backed securities and treasuries. Number two, the Federal Reserve can buy corporate bonds. And number three, the Fed can lower interest rates. Unfortunately, with interest rates at the lowest threshold we have had in years, we are at 2.25%, which is considered the effective lower bound. We don't go lower than that. We might not be able to lower interest rates anymore. Now, there has been talk about bringing interest rates to a negative territory, but the reality is we have a Federal Reserve Board that says there are too many negative side effects of having negative interest rates, and therefore it's unlikely we're going to see negative interest rates anytime soon, coupled with the fact that the European Central Bank had a rough time with negative rates. Negative rates, because of this, are unlikely to actually come to America. And after all, borrowing costs are already pretty low. In fact, borrowing costs aren't so much of an issue right now. Instead, tight credit requirements are, and standards at banks is a greater issue, and ultimately a greater threat to businesses and individuals who are struggling to get financing due to these strict lending criteria. Steve Mnuchin, the Treasury Secretary, supports tight lending. In fact, he's been taking notes from Hank Paulson during the last financial crisis, where the Troubled Assets Relief Program, TARP, did not end up losing the Treasury and the government any money. Steve Mnuchin does not want to go down in history as being a Treasury Secretary who loses the country money. And this is partly why the Main Street Lending Program, which is a partnership between the Fed and the Treasury Department, has been pretty much all but frozen. So, what about Treasury bonds and mortgage-backed securities? Will the Fed come in and buy these bonds, and what effect will that have? Well, Treasury yields have fallen again off their highs just within the last 24 hours, signaling again that the stock market is a little anxious and nervous, and investors are fleeing to the safety of bonds, or the alleged safety of bonds, driving bond prices up, which brings yields down. Buying more mortgage bonds and Treasury bonds is an option for the Fed, and it's one that they are likely to ramp up if economic certainty increases. If the Fed, and here's who benefits from this, if the Fed comes out and buys more bonds, yields will fall. Again, as bond prices rise, yields go down, which basically means the 10-year Treasury and the 30-year Treasury and these other bonds go down in their effective rate, which tends to have the effect of dragging down real estate interest rates and borrowing costs for corporations. Today, the average 30-year fixed-rate loan is about 3.03%, with many qualifying for 30-year debt in the 2.75% range. And that's wonderful for real estate purchasers, but what does that do for us individuals? Well, unless you own real estate, not too much. But what about corporate bond purchases? I mean, that's gotta help, right? Well, in March, the Federal Reserve bought bonds of nearly 800 companies with investment-grade debt. These companies included Toyota, AT&T, Apple, Verizon, Volkswagen, GE, Ford, GM, Microsoft, Comcast, CVS, BP, and more. And the benefit of the Fed buying corporate bonds is simple. If companies need money, they sell bonds, which is a way of raising debt. The Fed comes in and scoops them all up, buying them, basically injecting companies full of low-interest printed money to keep their employees employed. That's the theory, at least. Now, both of these are very likely. Well, actually, all three of them. We're likely to see Treasury purchases. We're likely to see mortgage-backed security purchases. We're likely to see corporate bond purchases because that's what the Fed has been doing. And what would make them not want to ramp that up again in the event that there were issues? So this is good because what does it do? Well, it helps eventually stabilize real estate prices. If rates fall, in fact, real estate prices will just continue their tear upwards. Probably not the healthiest thing, but that's the trajectory, and that's kind of what the trajectory of real estate prices has been. And with billions going into corporate bonds, firms will have more liquidity, which tends to act as a way of backstopping the stock market, aka bailing out stocks. So yeah, the Federal Reserve has already said they've got plenty of tools available like this, and they're ready to use these in their toolbox, and they'll put them away when times are better. So stock stability and real estate stability are definitely things that might come if the Federal Reserve comes out and says, you know what, we're ramping up our bond buying. Unfortunately, what does that mean for the average worker who's unemployed or without stocks or real estate? Well, it means more pain. Even if the Federal Reserve comes out to bail out stocks and real estate again, the Federal Reserve has almost no tools available to help individuals. That's where Congress has to come in, yet half of Congress says, oh, well, we're in a self-sustaining V-shaped recovery. We don't need to do anything. We might even be in a super V. So what does this mean for us practically? Well, number one, as always, keep debt as low as possible. Number two, be prepared to draw down your credit lines and pull money out of wherever you can, out of your sock drawer, out of your credit line accounts, wherever you can, start stocking up money. And when the market turns red, like it does on days like today, I personally recommend nibbling in and getting into the habit of training yourself to buy a little bit on red days consistently. I've also steadily been reducing margin over the last 2 months, and I feel great and very comfortable going into volatile times because the last thing you want is a lot of debt during these times. However, I want to remain vigilant. It is likely, in my opinion, that this red market streak may continue. That doesn't mean I'm not going to continue to trickle in the market because, again, psychologically, I like doing that. It gets me buying on red days, and it prevents me from buying on euphoric green days, which, remember, when prices go down, it's actually safer to invest than when prices go up. Even though it feels safer to invest when prices go up, it's much safer to invest when prices go down. It feels opposite. Anyway, number three. As painful as it is, just do it. The volatility index, the CBOE volatility index, aka the VIX, is up substantially again. It is at a level of 40. We briefly hit a level of 40 on June 11th when we had a stock market pullback in the recovery sector. And it's like, oh crap, summer wave of COVID cases. And then we had a pretty, substantial spike in the VIX between March 5th and April 23rd. And honestly, if I look back, I go, yeah, if I was going to invest again, March 5th to April 23rd, even though it felt like crap, it's the time to do it. So keep an eye on volatility, folks. Keep buying, stay in the market. In my opinion, Don't sell. This isn't the time to sell unless you're like super buried in debt or something, then you might want to. Some have suggested, hey, maybe it's time to buy some puts on SPY, you know, basically to buy an insurance option on your stock portfolio. Not something that I'm personally going to do. I'll ride the wave and I'll keep adding in with money instead. Thank you so much for watching this video. Hopefully the Fed comes around and makes us all feel a little bit better. And honestly, hopefully Congress gets their act together so the people the Federal Reserve can't reach get help. Thanks so much for watching. Check out those courses. Get your life insurance in as little as 5 minutes. Check out the amazing link down below for Webull, where if you deposit $100, you get up to 3 free stocks worth up to $1,600. And folks, we'll see you next time.